On April 23, 1992, the Times of India published a major report that paralyzed the country's financial district. 500 crore rupees was missing from the State Bank of India. The investigation centered on Harshad Mehta, a stockbroker who rose from Mumbai's scrap trade to become the big bull. He commanded the Bombay Stock Exchange with a level of wealth previously unseen in the country. His lifestyle signaled total market dominance. He lived in a 15,000-square-foot Mumbai penthouse and owned 29 luxury cars, including a Lexus LS 400, a model so rare in India at the time that its presence on the streets was a national news event. Mehta siphoned capital from the state's most secure financial institution by targeting a specific blind spot in the manual record-keeping of the banking system. The Bombay Stock Exchange in the 1980s was an entirely manual environment. There were no computers. Thousands of traders climbed into a physical ring, using hand signals and paper slips to execute every trade. Mehta realized that conventional tactics had a limit. While insider tips and small-scale manipulation provided steady returns, he aimed to move the entire market at will. To dictate share prices in a market of this size, a broker needs massive, constant capital to keep buying even when the rest of the floor is selling. Because the stock exchange lacked that kind of liquidity, Mehta looked toward the money market, a separate, institutional world where the scale of cash was exponentially larger. The money market is where commercial banks lend each other massive sums for short durations to meet their daily cash reserve requirements. Banks used brokers for trades. Cash sat in the broker's account for 2 weeks before delivery. Mehta diverted these idle funds into his portfolio, drove up share prices, sold at the peak, and returned the principal before the window closed. This float exploit provided significant leverage, but it was still tied to the volume of legitimate loans happening between the banks. To scale further, he needed to manufacture the loans himself. Banks didn't exchange physical government bonds for these short-term loans. They used a paper surrogate called a bank receipt, or BR. This document was a simple promise that the bank held the securities on the broker's behalf. Mehta had small banks issue bank receipts with zero collateral. He traded these to the State Bank of India for massive cash. This created a perpetual cycle. He bought shares, raised his portfolio's value, and borrowed even more against inflated assets. The impact was most visible in ACC Cement. Mehta's concentrated buying drove the share price from 300 rupees to 10,000 rupees, a 3,300% increase that had no basis in the company's actual earnings. This meteoric rise in Mehta stocks triggered a psychological gold rush. Seeing these returns, millions of retail investors flooded the market with their own savings to chase the trend, collectively pushing the entire Sensex up 460% in just 2 years. The exploit relied on the banks never talking to each other. That ended when the Reserve Bank of India investigated discrepancies in the money market and demanded a reconciliation of all outstanding bank receipts. The State Bank of India discovered they were holding 500 crore receipts that didn't exist. Mehta was ordered to pay immediately, but his wealth was tied up in the very stocks that were now beginning to falter. As news of the shortfall leaked, the market entered a freefall. The same retail investors who had chased the rise now scrambled to sell, but there were no buyers left. The crash wiped out 4,000 crore rupees of value. Across India, families lost their life savings, pensions were liquidated, and the small investors who had followed the big bull were left with nothing. The scandal forced the government to acknowledge that the nation's entire financial backbone had been compromised by a single broker exploiting manual paperwork. Harshad Mehta was arrested and his assets were frozen. After a decade of legal battles, he died in custody in 2001, leaving behind a legacy defined by the systemic wreckage he caused. In the aftermath, the government transformed the Securities and Exchange Board of India into a powerful statutory body and permanently banned the use of manual bank receipts for interbank trades. India moved to a fully digitized, screen-based trading system. Every transaction is now tracked in real time by centralized clearing corporations, removing the float that Mehta once used to hide his movements. This scandal forced the transition from manual paper receipts to T+2 electronic settlements and rigorous SEBI oversight, creating the regulated infrastructure used by millions of